My super easy scalping strategy that I use every day will make you tens of thousands of dollars every month in the markets if you just listen to what I say. After 8 years in the markets, I found super profitable ways to scalp, gold especially, but this can be done on any pair, any strategy, any market, such as crypto indices, such as commodities, such as futures, such as FX markets. Everything can be done. Every single market you can use this strategy for. So no matter what you trade, this video is going to help you a lot. So let's jump straight in. Why does this strategy work so well? Well, firstly, this works even if you have a job, or if you go to school. You can literally trade for an hour a day, find a high probability setup with manipulations, and take a very good trade. You can make profits in a small amount of time. There's no guesswork involved. Everything is strategy. Everything is waiting for the confirmations needed to take a trade and then taking them. This also works for complete beginners. So if you're a beginner in the markets, you can actually pick up the strategy very, very quickly, because especially if you haven't already traded other strategies, this is going to be like, oh cool, this for this. But then there's a thing, if you've traded other strategies, it could also be good for you too, because you already know how other people think in the markets and you can use that to your advantage. 1 to 2 risks to reward at every single trade. So again, this is just what works. I'm actually in a trade right now. It's a live trade that I've taken, which is almost at a 1 to 2 risk to reward. Once it hits that, I'll close out the trade. The idea. So the market moves to trap retail traders, which are the majority of people in the markets. And we profit by trading against the obvious direction once they've all been trapped. So once we can see that everyone's going into a long right now, right here, several strategies, 5, 6, 7 strategies are going long now, we can actually jump short with the right confirmations and take all that liquidity out with the big people that essentially move the markets. So step number 1 is having a higher time frame bias. So you want to figure out if people, the majority, are buying or selling, because basically if price is bullish, making higher highs and higher lows, we should look for inducements, or to trade inducements, which will be making a lower low. If price is bearish, making lower highs and lower lows, stepping down, lower high, lower low, lower high, lower low, lower high, lower low. I don't know if I did that right. Lower low, lower high is what I meant to say, but it's all good. You guys get what I mean. When price is making lower highs and lower lows, then we are bearish. We should be looking for an inducement to take all that liquidity out, make a higher high, leave everyone else confused. Step number 2 is liquidity zones. So liquidity are basically stop loss orders, and big players love to target them. They come in the form of support and resistance, where, for example, support is where buyers get into trades. They're trapped once that gets taken. Resistance zones, sellers are trapped. So price is reacting from a resistance, sellers are jumping into the market. Once they're trapped, we take that resistance out. Supply and demand. You want to mark zones that have 2+ touches. So the more touches, the more likely they're going to break. If prices come in, make 3 equal highs, and price is bearish, we want to go look to take those equal highs out, because that's, a strong form of liquidity sitting there. 4 equal highs, 5 equal highs. Strong liquidity that is eventually going to get taken. So now resistance and support, basically where price comes into several areas. When price comes back into an area that's retested before, such as a support zone, such as a resistance area, then we're expecting, for example here, price comes up, comes back down, taps into support, pushes up, creates a resistance, pushes down, comes back, actually breaks the resistance this time, before stepping down and breaking support level. So again, resistance and support, they're not going to be accurate, but they're a guide, and we can use them to our advantage by looking to take them out. So here we have stop losses of short traders above price. What that means is, in this consolidation zone, people are shorting at each of these highs. Shorting. Their stop losses above this high, or in this zone where the red is. Now the long traders are longing, so they're buying. So prices below, they're buying. Prices below, this area is here. So what often price will do is it will take out the short sellers here, take out the buyers, and then continue on its way. So again, think of it like a slingshot. Where's the liquidity? Let's get it. Where's the liquidity now? Let's get it. And then where's the liquidity now? It's all a game that the market makers play. If we can just understand how that game is played, we can make a lot of money in the markets. So step number 3 is bullish and demand zone and Fibonacci. So if we have a Fibonacci retracement tool from swing high to swing low, we can see basically where the most retail traders are getting in. So once price hits that 61.8 to 78.6% retracement zone, this is when the retail traders are jumping into their trades based on the Fibonacci strategy. What we often see is that we have demand or supply zones that line up with the Fibonacci. And this is where many traders enter in the same direction. So what we're essentially looking to do is find out where most traders are entering so that they can build up liquidity in the market, and then we take that liquidity out and take them all out at once. So here it is, right? We have a high, we have a low, we have our Fibonacci 61.8 retracement. We also have trendline liquidity above price. So if we had a reaction from here, trapping in retail traders, what can we look to do next? Boom. Take out the bearish range, take out the trend line, and take out the fib traders all at once. Their stop losses are going to sit above here, so they'll be all taken out at the same time. Step number 4 is our entry model. We do this on the 15, 5, and the 1 minute. So what we want to do essentially is we want to wait for a fake move, which is essentially a false breakout. We see this on the 1 minute chart. Often it will look like a break of structure. For example, bullish break will go short. This could be a weak rejection from our zone or strong reversal candles, such as engulfing candles, trapping traders in a certain direction. What we do is go the opposite way, go for a 1 to 2 risk to reward, enter once the trap is obvious, of course, and have your stop loss at an invalidation zone where you're going to be wrong on the trade. So I'm going to show you a real live trade example that I'm actually currently in as we speak. This is on the 15-minute time frame here. So what we wanted to do is we want to really look at what structure is telling us. So on gold here, we can clearly see that we have price coming down, making a lower high and a lower low. So we have structure between this high and this low. We also have price returning into round about your 61.8 retracement zone. So if we just pull our Fibonacci out from high to low, we'll see this is your 61.8 to 78.6 retracement, or quote unquote golden zone. But what do we notice also here? It's what most traders miss. We have a resistance level. So that resistance level is why price will come up, trap traders, and then go and take that out. So it's like a game that the markets play. Now, if we jump down onto the 1 minute time frame, which is actually where we get the clearest price action here for an entry criteria, what we will see here is that, of course, this resistance zone becomes more and more clear. Price is now going to take that. This is a trade that I'm currently in, just waiting for my 1 to 2 target to be hit there, which is very, very close to being done. Very nice trade. It's going to be a very nice day for me. We have price coming in, making this low. Then we see, look, price comes up, steps in, pushes to the downside. Again, this is like an early trap. This is very early, like half an hour before New York session. So this could be a trap. So first, where are the stop losses of these traders? Above here. What does the market do? Takes them out. But then after that, look what it does. It taps once again into the resistance level and then breaks structure to the downside. So now we have this little bearish push. But what we saw after that is that we actually have a support level right here. Now that support level is something that is quite significant, because as you can see, we take out the support and then pull back. So on that pullback, I entered this. My stop loss covered these lows in case price would come sort of test any of these areas. So I covered my stop loss there, went for a nice 1 to 2, which is almost hit. And I probably might even just close out here, to be honest. It's you know what, I'll leave it. 1 to 2, almost there, we'll hit it. Now what we can see is we entered on price pulling back. Now the manipulation is this area here is a very big imbalance zone. So a lot of traders coming into New York Open, which is right here, are going to be shorting at this area. So you can see that price comes into New York Open, pushes into that supply, in this 1 minute supply, but you look right where that resistance level is, it's right there. So what does price decide to do next? Boom, boom, take the resistance out. There's no luck or there's no guesswork. It is literally see the manipulation happening, take a trade, go the opposite way to the majority of traders, be that support, resistance, supply and demand, SMC, market structure, Fibonacci. And once you can identify that, you can actually have these highly profitable trades day in and day out in the markets. And it's really quite amazing to see that even some of our students are having insane results trading this way. And really it just shows that the best way to make money is to think like a trader, think like the rest of them, but do the opposite. And if you want my free course, the first link in the description, it is all there for you. Let's get to work, guys. If not, like, comment, and subscribe on this video. I'll see you next time.